Well, today we've got some exciting information to share, but before we kind of dive into some of these alternative programs that exist outside of what we'll define as agency. And so by agency, when a lender says that, generally they're referring to Fannie Mae or Freddie Mac if it's a conventional loan. And if it's a government loan, they might be referring or using agency as FHA or VA. But for today's purpose, we will be talking and exploring some second home and investment property options. Let's frame what we're going to talk about a little bit here, Tara, because what we don't want to do is complicate this. So, like, simplistically, I think it's important to know that Fannie and Freddie changed their pricing guidelines on second homes. I don't know. I'm going to call it like 2 years ago. I feel like
It was almost exactly. It was April 1st, 2022 is when it was implemented. Yep.
Okay. So, wow, that was a good guess. I feel pretty good about myself. Anyway, what happened was, so prior to this change, second homes were priced from an interest rate and a cost standpoint very similar to an owner-occupied type of transaction. So those rates were in line, and we saw the big discrepancy when we jumped to an investment property.
Right.
Well, with the changes that occurred 2 years ago, the pricing changed. It got more expensive. So Fannie Mae and Freddie Mac said, you know what? Hey, we're going to actually align second home pricing with that of investment property pricing. And so since then, it's been a whole kind of spiral of what the agencies offer and the impact of interest rates on second homes. And so today we're going to talk about some alternatives to that. There are some reasons why a lender may still use an agency second home type of program, namely for down payment. And then we're going to show a few different options with Mortgage Coach to kind of just do a side-by-side comparison to really make sure that if you have buyers that are purchasing either a second home or an investment property, to know that there are options out there outside of Fannie Mae and Freddie Mac. And this is the key. And you're going to see as we open this up, some of the nuances, and they're kind of like little special lanes or categories of where this non-agency loan gets very aggressive. So, Tara, before we do that, or I guess just go ahead and tee us up.
All right. So let's talk first about second homes. So there are still, so while interest rate and pricing is very much aligned between second homes and investment properties, there are, second homes allow for less down. So that's a bigger difference. Second homes allow for 10% down. Investment property got to be at 15% down. That's probably the biggest difference, I would say, between second home and investment property.
Other than mortgage insurance, right? So again, 20% down on an agency, second home loan. It's going to have mortgage insurance. You're going to see with column 2, we have a non-agency investor where we can do, the buyer can do 15% down with no MI. So let's kind of walk through it. So column number 1, this is what, again, we're going to call agency. This is if you have a second home buyer and they want to put minimum down, then you're looking at a 10% down option. This does have mortgage insurance. Yep. And walk me through, Tara, you did a seller credit on this?
I did. So when we have second home buyers right now that want to do minimum down, interest rate and cost is very high, right? As you start to put more money down, interest rate and cost can get better. But at 10% down, because of where the interest rate and cost is, you have to get a seller credit to help with that cost. Otherwise, the loan is considered a high cost mortgage, which is not allowed by, lending and federal government guidelines. Like, you cannot sell or have a consumer obtain a high cost mortgage and pay a certain amount of points.
On a second home or primary residence, they are allowed on investment property. So this is where we start to get into nuances, guys.
Yeah.
But the big key here is that because of the margin compression that we've seen in mortgage-backed securities, when we look at interest rates in this scenario, 10% down second home, the cost is exceeding what we can pass through to the buyer according to the high cost mortgage guidelines. That's essentially what it is. So when we say, or a lender tells you, hey, they can do this, but in this case, they have to get 1.5 in this scenario, seller credit in order to make them eligible just from a high cost standpoint. That's why they're telling you that.
Right.
Good? Okay.
Yep. So if any second home buyer wants to do 10% down, a seller credit is needed, at least at this point, right? As the financial markets perhaps improve, interest rates start to come down, we will see a shift in this option. But for now, that's how I'm coaching clients. Like, if you want to put 10% down, we got to get X dollars or X percent in a seller credit to make it work. Otherwise, we got to look at, now we got to go a little bit further down payment.
Yeah. So let's kind of move over. So this is column one. In this case, 10% down with MI, monthly PITI payment right around $4,000 a month, with cash to close about $6,300 or $63,000. But that assumes a 1.5 seller credit in those numbers. But let's move to, and again, most second home buyers, I mean, we don't have a lot of 10% down second home buyers right now. I'd say most of them are open to that 15 to 20% down plus scenario. But we wanted to show you this because really the goal of these webinars is just to bring some insights from a mortgage standpoint or a lending standpoint that you might be faced with, or these conversations that you might be party to that just not really understand what's involved in it. That's really one of the goals here. So as we move to this 15% down, now we're going to take it out of agencies, meaning that we would not be committing or selling this loan to Fannie Mae or Freddie Mac. And here, what's interesting is now we no longer need a seller credit because of the pricing. The rate sheet looks different. It allows for a higher interest rate, but less cost for that rate, right, at 15% down with no MI. So you'll see that total monthly payment right around that $37.31 number, with cash to close right around $86.2. Any comments on that one, Tara?
No, that's exactly right. I mean, it's a great option. The monthly payment, you're putting more down, but no, it's a great option if a seller credit is just not available.
Yeah. Now, here's where we get really excited. And y'all know me, I get really excited. But when we started really looking at the difference, 20% down, non-agency, so not taking this deal to Fannie or Freddie, 20% down. Look at this interest rate difference between the 10% down agency versus 20% down non-agency. It's a good 0.75% difference. And Tara, if you were going to price 20% down agency today, how would that look?
I already realized I probably should have added that option. It would be in the eighth, definitely still in the inflated eights for the less cost. So at 7.75, I mean, we could pop into other pieces of this mortgage coach, but I believe call it paying one discount point, right?
Yeah.
Where if it was 20% down agency, 7.75 would probably be at 3 discount points, right? The cost just is still inflated going agency.
Right. So I just went into the closing cost screen so you can kind of see what the cost is in connection with that rate based on these assumptions. So the big win and the point of this is just to know that there are options out there that could be cost effective for your second home buyers. And we're going to move into investment properties here in a second that are outside of what, most lenders kind of default to. And that's really the key here.
Yep.
Okay. All right. So before we kind of exit second home conversation, anything else that we want to cover that's important?
I don't think specifically. I think after we talk about the investment property one, we'll talk a little bit about how the non-agency guidelines differ from agency, but it's going to be broad and it will encumber both second home and investment. Yeah. So I don't really want to dive into that until we go through the investment.
So Alexandra has a really great question. She said, what seller credit is needed for 5% down? Fannie Mae and Freddie Mac do not allow for a 5% down second home structure. So it's 10% is the minimum down payment on a second home. And that's why we showed that one. But if it's a primary residence, now everything changes. So everything we showed you is out the door because now the way that primary residence or owner occupied transactions are priced through Fannie Mae and Freddie Mac are completely different. They don't have those same loan level pricing adjustments. Hope I did answer your question.
Max seller credits do differ on second homes versus investment. So that's one thing that the second home mirrors if owner occupied in the max seller credit you can receive. investment is different. But, I feel like as our market is changing, and especially on second homes, it's a little harder to negotiate those large seller credits. But you can get up to, at 10% down, you can get up to 6% of a seller credit on a second home.
Yeah. Versus what everybody kind of thinks is 3% on a conventional loan, sure, which, is anything less than the 10% down. So, all right, let's move into our investment property strategy. And it is interesting, although investment properties are down just from the number standpoint, according to what we just saw in Cromford, we still have a, certain percentage of the population that are still buying properties for a buy and hold scenario. So that is what kind of created this cost analysis. And so Tara, go ahead and walk us through it.
Yeah, so I started with, I guess it's important to know that Fannie Mae Freddie Mac agency will allow a minimum of 15% down on an investment property. I honestly don't know the last time we saw an investor putting less than 20% down. I mean, it has mortgage insurance. Most investors are beyond that point. So I started here with a 20% down. The first two columns just strictly comparing agency, Fannie Mae Freddie Mac, to the non-agency, non-QM program. And it's significant as far as the interest rate.
So this interest rate kind of, again, just a generic quote, like 8 5/8 on an investment property, 20% down, total monthly payment, PITI, right around just under $3,500. And let's take a peek really quick to our discount points. So that is with what, 2 discount points?
So I kept it consistent. So with the 20% down, like you're going to have to pay 2, right? Agency. If we go non-agency, we could go higher in rate and reduce the cost. For this purpose, I just mirrored it to show how much better the interest rate could get for the same cost.
Right. So this is cool. Look at you guys, just a kind of a side-by-side comparison right here. 20% down agency, column 1, 8 5/8. 20% down non-agency, it drops to 7 7/8. Same discount point, same scenario. That is a impactful change from an interest rate standpoint. So the reason, again, we're bringing this to you is that not all lenders have access to what we call these kind of non-agency or non-QM types of loans. They're 30-year fixed rates. They still have underwriting guidelines. There's still a process, but just kind of know if you have buyers in this second home or investment property space, whether you're talking to us or somebody else, we hope you talk to us. We do lend in 45 states across the country, but if you don't, just be sure that you're kind of tuned in on this nuance, because this could make or break the borrower's qualification or just their willingness to want to purchase, an investment property or second home just based on rate. So as that rate drops, again, same $500,000 purchase price, 20% down. Now the rate drops below 8 on an investment property. Total PITA right around $32.65 a month with cash to close still in line about that $114.5. Keep in mind, as Tara mentioned, that on investment properties, the max seller concession on agency is going to be 2% of the purchase price. Tara, is that the same on non-agency? Do you know?
That's a great question. I believe so, but we can confirm.
Okay. Now, get excited. Hold on to your seats, because here is something I haven't seen in a long time meaning about 18 months or so as we go on this interest rate rise. Look at this, you guys. 25% down, investment property loan at 7 1/8. So my goodness, I mean, we're almost in the 6s there. Or as I mentioned, if you want to increase the rate and reduce the cost, this option gives us all the flexibility. But you can see it's like in that 25% down. And that's what we find when we get into pricing mortgages. There's so many factors that go into that price, the down payment and property type and occupancy type, those all drive the equation. Yep.
So even at 20, this investor program is really cool. Again, non-agency. If we went agency 25% down, we would not see the interest rate in the low 7s. I mean, that's almost owner-occupied interest rates at that point.
Yeah. And so now we've got this kind of total monthly payment, just under $2,900. That's obviously PITI. So that does include taxes and insurance. And our cash to close increases a little bit just because of that extra 5% down. But we do find these conversations with investors that are wanting to buy and hold. Sometimes this is something that excites them. So just knowing your options is really the key. Any other questions or comments on that, Tara?
I don't think so.
Okay.
Kind of talk about the guidelines that.
Yeah. Let's talk that. Let's talk a little bit about the guidelines, because it's not just one and done. I think there's so many different scopes and so many different little nuances that can change the course of any home loan kind of pre-qualification, pre-approval, or approach. And so if you were just like a fly on the wall in our office, you would hear us say things like, oh, okay, so this came out of a meeting this morning, oh, okay, so buyer wants to use a bank statement program, but they're going to have to tap into some of their assets that we're using the bank statement program from that account. Is that doable? Got to go to the guidelines to check it out, right? How many months of reserves do we need on these programs? It is just, it's just step by step by step by step, but all of this criteria that's easy to miss, honestly.
Oh yeah, very easy. I mean, Fannie Mae and Freddie Mac, you guys think of it like fitting in a box. Like someone's scenario fits in a box. These non-QM is like, this is out of the box. Like there's different debt to income ratio, requirements, different reserves. There's all sorts of little things that definitely, if a lender is taking a client in this direction, got to be pretty dialed in and do all your due diligence.
Yeah. And part of that due diligence for us is really getting income and asset documentation up front. And again, I think that it's important to know that there are lenders across the country that do not get documentation until the buyer is under contract. And that is just so foreign to the way that I think about the business. And I think what serves our public best, because I will tell you, the devil is in the details when it comes to income and assets. So think about that, unless you're talking with an engineer, for the most part, people don't know exactly how much they make. You would think that they do, but they don't. And then, just time up. If it's variable hours, maybe they got a bonus. Maybe they didn't get a bonus. Maybe they're including that in the income that they put on the online application or the phone app when they're talking with a lender. All of that can move that person from being eligible to not being eligible for a particular program. So we've just found in our experience that getting the information up front really sets all parties up for success. And hey, stuff happens during the process. Let's just call that as rated. Are not perfect, nobody's perfect, but we do everything we can to ensure that we have really dug deep into those assets and income, because that's really the points of the home loan that tend to get off track. And that's where, unfortunately, disappointment happens. So Tara, talk to us a little bit about the non-QM lending guidelines. You mentioned the reserves. What is reserves? When a lender says that, what does that really mean?
Yeah, so just having money, either liquid or non-liquid, right? Could be investments, could be retirement, in accounts after closing that equal a certain amount of your primary residence payment plus your new, all real estate owned really, but your new home that you're purchasing, investment or second home.
So for example, let's say that the loan program requires 6 months PITI in reserves for all real estate. If that buyer owns 3 properties and all of them have loans on them, then it would be the PITI payment plus HOA on all 3 properties times 6. So that's the amount we would have to be able to document in one of their asset accounts to ensure that they had that money plus the house that they're purchasing. So that would be property number 4.
Right. Right.
And that's probably one of the biggest differences we see when we get into especially investment properties. The lending guidelines are wanting now reserves, which isn't necessarily what we see on like a primary residence approach.
Right. Right. And agency will still require reserves. I'm not saying that Fannie, Freddie won't require reserves. They typically do. But when we go Fannie, Freddie, we run an automated underwriting system and it shoots back to us what is required as far as reserves, where these non-agency programs are going to be very specific, on what you need. It is 6 months, no matter what, or 3 months, or there's different tiers, So if someone, it does, just because they don't have 6 months doesn't mean you're not going to qualify. It's just we're digging further into the guidelines, into the different programs. Maybe an interest rate is slightly inflated. There's so much like wiggle room with these non-agency programs, which makes it's really great because you can typically find a solution, but just lots of little nuances. So
it's also easy to miss. From a lender standpoint, let's just be real. It's easy to miss. If you're off on, or you miss the, reserve requirement and you're quoting a rate, and then you go back into the assets and you're like, oh my gosh, I'm off a month or whatever that is. Now the lender's scrambling, trying to figure out how to do that because the rate that they gave was based on this information and this number of months of reserves or whatever else that it was based on. So when we get into the non-QM mode, it's really important to ensure that you're working with a lender that really understands the approach and is getting all the documentation up front. So some lenders don't. And I'm talking like big lenders. There are some big lenders out there that are nationwide that I'm like, are you kidding me? Oh my goodness.
Well, and clearly communicating to the buyer, we cannot have your assets dip below, right? Don't go buy a boat for cash because we need those.
Remember that conventional loans are the loan product that your buyer would be using if they're purchasing a second home or an investment property. What we'll call our government-backed loans, which would be VA, FHA, and USDA. Those are for primary residences only. We are seeing a trend up, especially with FHA. I don't remember exactly what Tina Tambor said on the Crawford, but I feel like she said FHA is now about 30% of the finance in the Phoenix metro market. So again, we're seeing FHA on the rise. Any comments, Tara? I think sometimes we hear pushback from listing agents with regard to FHA. Do you want to kind of walk through truly, the difference on FHA versus conventional?
Yeah, I would say the biggest difference is going to be health and safety items of a property. I would say, there is a lot of information out there that because they're going FHA, they're less qualified. And that's just not the case. There are so many, reasons why someone would go FHA versus conventional. It could be credit score. It could be debt to income ratio. It could just be down payment and the strategy that we chose that benefits them. It doesn't mean they don't qualify conventional. It's just FHA is a better financial decision for them right now. So when I talk to agents, it's really just health and safety, or it's a condo, right? It would have to be FHA or VA approved versus conventional. We still do the approval process, but more likely to be approved, from that standpoint. But
health and safety is important to know that Tara's referring to the appraisal process. So, for example, probably the number one thing we see on FHA appraisals that gets called out is peeling paint on the fascia board. That is deemed to, be something that must be repaired. And so, again, the appraisal might be subject to that being scraped and then repainted. The appraiser goes back out prior to closing, certifies that the work's been done, the work is, I definitely think the appraisal process is something that agents have concerns about, but really, other than health and safety, they're pretty comparable. One other thing, too, is just with regard to mortgage insurance. Remember on FHA loans that if they're doing less than 10% down, mortgage insurance stays on the loan for the life of the loan, which means it's never going to drop off based on current market value, which is different. When you move into conventional financing, there is an option to drop mortgage insurance at some point in the life of the loan without needing to refinance. So again, that's something that a lender is weighing as we're presenting options. But it could be FHA definitely makes sense because maybe the mortgage insurance is less expensive based on credit score, etc. So on conventional home loans, mortgage insurance, the cost of mortgage insurance is driven based on credit score. Could be down debt to income ratio and credit score.
Yes.
We move over to FHA. It's not the case. It's just one flat cost for mortgage insurance. No matter if you're doing, 3.5% down, I guess there is a slight drop if you do, more than the down. Materially, it's not driven by credit score or debt to income ratio. That is one of the really big differences. And to your point, Tara, that's why sometimes, especially with higher rates and affordability, we're really trying to approach this from a strategic manner, saying, okay, well, you don't have the same option as you would with regard to mortgage insurance dropping at some point. The likelihood is you may be setting yourself up for a refinance anyway, depending on what expensive rates. And so out of the gate, your savings is X dollars a month if you choose this over that. So lots of those conversations are happening today.
Yeah.